guys, thanks for coming to my market report. This is Mike, and this report primarily focuses on mortgage rates and what the trends are and what primarily influences rates on a daily basis. And we do touch a little bit on the stock market as they do correlate. But without further ado, why don't we start off with the economic report being done today, February 26th. We'll start with the personal income for the month of January. So back in December, we had a 0.6% increase. However, forecast was supposed to be a big jump in the month of January at 9.5% and exceeded that to 10%. So a nice increase there, primarily because a lot of people are going back to work in January after a lot of the COVID lockdowns in December. Now we also got the opposite, where we got consumer spending for the month of January, where we had a decline of 0.2% in the month of December. However, in forecast for January at 2.5%, and it came in pretty close to that at 2.4%. Now we also got the Fed's favorite gauge for inflation. This is the personal consumption expenditure, also known as the PCE. This is a headline number, uh, which grew on a month-over-month basis at 0.4% back in December. However, in January, it rose 0.3%. Now, it's yearly, year over year, it went from 1.3% all the way up to 1.5%. Now, this is what the Fed will really look at. They look at the core PCE. When they strip out volatile pieces like food and energy, we get the core PCE here. So on a month-over-month basis, it went from 0.3% back in December. Forecast come for 0.2%, but it also continued that trend at 0.3% in January. Now, its year over year remained the same. As you can see here at 1.5%, forecast come for a slight dip in January, and it came in at the same, unchanged at 1.5%. Now, we'll touch on this a little bit here, but we'll continue for right now. Chicago PMI, this is manufacturing in the Chicago region for the month of February. So it's anything above 50 is considered expansion. So we had a 63.8, which was doing pretty well in the month of January. Forecast calling for a slight dip to 61.1, and it dipped a little bit further to 59.5. Last but not least, we got the February consumer sentiment. So its initial reading for February was at 76.2. Uh, Forecast was calling for a 76.5, and actually went up a little bit to 76.8 from the initial reading. Now, January's number was actually 79, so it dipped from 79 down to 76.8 for the month of January. Just kind of show you that it improved in February, but it dipped from January's numbers. Let's take a look here at the headline news. Stocks are a little mixed today. Dow's the only one right so far in the negative territory. This whole week it's been all about the yields, the big sudden rise in yields. This has a big impact primarily because yields give kind of like a perception of inflation. It doesn't exactly mean big inflation that it's going to go in, but when there's inflationary data out there, yields will typically rise, and that helps stave off inflation by slowing things down a little bit. Now, on this, there's a couple components that were also a factor. We had the Fed. They were concerned that the Fed may go ahead and start raising rates sooner. There was also concerns that the Fed may also pull back on their asset purchases when they buy treasuries and mortgage-backed securities and other bonds, that they would scale back on that sooner than they had expected. That's helped stimulate this economy and keep rates lower. Now, also, most of the stocks that were affected by this were NASDAQ or tech-heavy stocks were more affected by this. And also, they go into competition because these are, as we've seen, the stocks have been skyrocketing for over a year now, rising and rising and rising because of the low interest rate environment. Now that interest rates and yields have risen so much, they are re-evaluating at the values of these at these high costs, and they're scaling back on those costs because they now are at a higher than value than what they should be with the higher compared to what their current rate environment. Some of these investors may stick their stuff in more safe in safeties like that are more friendly to yields at the right rate they'd like to receive at. So you're seeing this transition here, and we're still haven't seen any flexibility. We haven't really seen this much movement since since the whole pandemic happened around last March, when all this started happening. The last time before that was when they did the taper tantrum several months prior to that. Let's go ahead and take a look at the mortgage rates and see what they're doing so far today. As you see here, we had a huge wide uncertainty rate here. We were down, we ended up closing down 94 basis points, which basically translate 1 point in pricing in one day here. So that was a huge loss from where we set up here on Wednesday all the way down here on yesterday. And this led up to lenders repricing multiple times yesterday for worse pricing due to this. Now, currently, we're up about 2 basis points. The inflationary data that came in at PCE is kind of easing up a little bit. We are down for the day. As you can see, we started here. We were even up higher, and then we scaled downwards. We still got very volatile. We got rocky waters ahead, but hopefully today's PCE number showing some uh, useful information, as in we're still pretty tame. Hopefully that will come in. Plus, on the prospects of what Jerome Powell had said at his testimony, he doesn't anticipate we may have some temporary or transitory spikes, but he doesn't over long term really be a factor or even hit the inflation goals for another 3 years is what he's anticipating. So again, that eased over the 2 days, but yesterday, of course, it kind of disregarded, and the market was kind of thinking that they may not be necessarily agreeing with Powell on that sentiment. So again, here's the yields. We're up just under 1.52 currently. We're in this record here. As you saw, we're way up here, way up here. It did scale back a little bit. It started the morning even lower here and worked its way up. Again, it's very volatile right now, and we'll have to kind of wait and see if we're kind of hitting some type of ceiling or some type of lid for now, and hopefully scale back a little bit. But right now, mortgage rates are about the same where we left off yesterday. Is again, rate. If you look at yesterday morning, we're much worse than where we started from. As I indicated, the rates lenders had multiple, probably about at least 3 different price changes yesterday due to the constant fluctuation in the worsening of the bond market here. All right, so if you guys got any questions about mortgage rates or anything else about real estate related, please feel free to reach out anytime. A little bit of background about myself. I am a loan officer and I do work with a national lender. We can certainly review anything or discuss a little bit if you guys were looking to refinance, different scenarios where you're maybe just looking for a better rate, or perhaps you're looking to go from a 30 to 15 year. Maybe you need to pull money out, equity that you've accumulated over the past spikes in appreciation we've been seeing. Or if you're looking to buy, we can certainly help you guys get pre-approved so you can make your offers and then finance those deals as well. Again, feel free to reach out anytime. You guys have a great rest of your day. Thanks so much for watching. Enjoy your weekend, and we'll see you on Monday's report. Take care.